Does your short-term rental actually reduce your W-2 taxes? A lot of high earners buy a short-term rental with the expectation that it will help reduce their tax bill. And sometimes it does. But what I see very often is this. People are told their rental offsets their W-2 without really understanding why, how, or under what conditions that is true. And that is where problems start. Because a short-term rental is not automatically a tax strategy. It only becomes one if it's set up, documented correctly. The first concept to understand is this: passive versus non-passive. For tax purposes, the IRS separates income and losses into two buckets: passive and non-passive. Most long-term rental properties fall into the passive category. That means if the property produces a loss, that loss generally cannot be used to offset W-2 income. Instead, it gets suspended and carried forward. Non-passive activity is different. Losses from non-passive activity can offset W-2 income. That distinction, passive versus non-passive, is the entire reason short-term rentals get special attention. Why short-term rentals are treated differently? Short-term rentals can be treated as non-passive, but only if specific rules are met. Those rules focus on average length of stay, how involved you are in the operation, and whether your participation can be reasonably supported. If those tests are not met, the activity is passive, regardless of how it's labeled on the return. This is where many strategies quietly break down, where cost segregation fits in. This is also where cost segregation studies usually enter the conversation. A cost segregation study is an engineering-based analysis that breaks a property into components, so certain parts can be depreciated much faster than normal. Instead of spreading depreciation over 27.5 years, portions of the property may be written off over 5 years, 7 years, or 15 years. That accelerated depreciation can create a large paper loss, especially in the early years. And if the short-term rental qualifies as non-passive, that loss may be used to offset W-2 income. But that's a big may. The part that often gets missed: cost segregation does not change whether an activity is passive or non-passive. It just changes how fast deductions show up. I have reviewed returns where the cost segregation was done correctly, but the activity itself didn't qualify as non-passive. The depreciation was real. The W-2 offset was not. One important clarification: that tax loss usually doesn't mean cash left your bank account. Most of the benefit comes from depreciation, a non-cash expense. You should understand how much of the loss is depreciation, whether the tax benefit is permanent or just deferred, what happens when you sell the property, and depreciation is recaptured. If no one explained that, you are only seeing part of the story. How this should be approached: a well-structured short-term rental strategy should clearly answer three questions. Why is this activity treated as non-passive? What supports that position if it's reviewed? How does this affect future years and the eventual exit? If those answers are not clear, it is worth slowing down. Short-term rentals can be powerful when they're done intentionally, but buying a property, running a cost segregation study, and hoping it offsets W-2 is not a strategy. If you're unsure how your short-term rental is being treated on your tax return, I offer free 15-minute calls. No sales pitch, just clarity. I will see you in the next video.